Hi there. So let's take a look at this in-class problem 7.2, a share valuation with constant growth. So in this problem, we've got this company that basically decides that it's going to announce a $1 per share dividend to be paid a year from now. And then they expect the dividend to increase by $1 a year for another 2 years. And then after that point, the dividend is expected to grow at a constant rate of 6%. Assuming basically a 14% rate of return or discount rate, what's the stock price going to be? As usual, sometimes it can help to draw a picture of what we've got here. So right now we're at time 0. And so if we just kind of say, okay, this is going to be D1, D2, and then D3. The first dividend will be $1. That'll increase to $2 and then $3. But then also at D3 after this point, this is actually going to increase D4, and then it will go perpetually at 6%. So what we're going to have to do here, in essence, is take the first dividend and discount it to time 0, take the second dividend and discount it as a lump sum to time 0. But then for the third year dividend, we're going to calculate the price of the share, assuming that the dividend grows at 6%. So we know that after the third year, if we multiply this times 1.06, this will result in a $3.18 dividend that will grow perpetually. So what we're going to have to do then is bring this dividend to be equal to P3 using the formula of P3 is equal to D4 divided by R minus G, where the growth rate is 6% and the rate of return is R. That's going to be $3.18 divided by 0.14 minus 0.06 or 8%. And that will result in a value of $39.75. Then what we do is we take both the $39.75 plus the $3 dividend that would be expected in year 3 to give us $42.75, which then would be discounted as a lump sum to today. If you're to use your calculator then, so in each case all we need to do is basically change the end value, because we know IY will always be 14, the payment will always be 0, each of these will be the future values, and all we're going to do is change n. So at n equals 1 and FV1, the present value is 0.88. At n equals 2 and future value equals 2, PV equals 1.54. And then taking 42.75 as the future value at n equals 3 will give you a present value, 28.86. So when you add all those together, you get a total of $31.28, and that is the value of P0, or the value of the stock that will have a dividend starting next year that grows at $1 per year, 1, 2, 3, and then at 6% perpetually. We can also show this using your cash flow function on your calculator. So if we're going to use your cash flow function, we'll make sure that we'll go under cash flows and we'll do second function clear to get rid of everything. And if we scroll through the list, there shouldn't be anything there. Now, because this is not an NPV problem, you'll make sure that your first cash flow is actually equal to 0, which it already is. The next cash flow is going to be $1. So hit 1, enter, and then down arrow, that's going to appear once. And then the second cash flow, CF2, is 2, and that happens once. Then for our third cash flow, we're going to put 42.75, enter, and 1 for the number of payments. Then NPV, make sure we'll put 14 for the interest rate. Scroll down and compute the NPV to be 31.27, 31.28. And that's how you do it using your calculator.